Hey traders, this is Ron Haidt at Market Tamer. Happy Sunday. Hello from Viva Las Vegas. I'm out here for the Traders Expo. Also would like to send a warm regards to all the veterans out there. Thank you for your sacrifice and your service. Before we go any further, the disclaimer. Nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. All right, let's kick off here with the DIA. The Dow was down a little bit on Friday, came off its lows, but if you look closely over here at the right-hand part of your screen, you can see we did finish above the 5-day EMA. So we've broken out on Wednesday, Thursday, and then Friday we pull back. This is the best looking index of the group. If I take a look at the SPY, which I have a bullish position in, the SPY still can't get over that orange line, that pesky orange line. That is the 50-day SMA. That is an institutional moving average. So short term, hey, it's above the 5-day EMA in blue. It's above the 20-day EMA in red. That does give the bulls an edge, but we really want to see it above that 50-day moving average. We take a look at the Qs. The Qs didn't fare so well on Friday. They gapped lower, was starting to look a little ugly at one point during the day, but did rally off the lows. And even though it rallied off the lows, it's actually below all of the major moving averages. The blue, the red, the orange, the purple, everything. Now it's below the purple, which is the 200-day SMA, just by a few pennies. It's nothing extraordinary, but it did finish below it. So the Nasdaq here doesn't look that great. If we go to the IWM, which is the Russell 2000, similar situation. It had a sell-off on Friday, back below its moving averages. The Qs and the IWM, they're looking bearish to start the week, whereas the diamond looks the best. If I had to package it all up, I still give the bulls an overall edge in the broad market because, one, we're through the election. Two, Friday's sell-off didn't occur on massive volume. Three, we're in a seasonally bullish time of year. It's just what the data says. This is typically, and you've heard it probably many times before, even on TV and whatnot, that the markets typically rally into year end. Now, to be precise, it's sort of now into the middle, around the 15th of December is when they typically rally. Then, as a broad market, they take a little 2-week break, and they start running up in January from a historical perspective. So, anyway, bulls get the edge. I got a lot I want to cover this weekend, actually. Here's the VIX. It was up a little bit on Friday, but even when the markets were selling off, the VIX wasn't popping like it was, crazy hot. It was only up a little bit. So the VIX isn't doing anything from a negative divergence or something like that. Take a look at the semis. They are sort of mirroring the Qs to a degree. They're back below their 5 and their 20-day moving average. Semis are short-term bearish. That is SMH. IYT could not punch through that 200-day on a consistent basis. So for the transports, and actually I'm going to go back to SMH. What do we see here on these charts? Left shoulder, head, and potentially the formation of a right shoulder. I'm going to go back to the semis. Left shoulder, head, formation of the right shoulder. So what I would want to see is this right shoulder high is taken out, which is basically 98 bucks. But then we have the 50-day and the 200-day. Those would be short-term targets. But if we start getting above 100, that would be a bottoming type pattern. Now, if I go back to the transports, it's much cleaner. With the 50-day coming down in a couple more days, it's going to be basically right at 195, which is going to catch that reversal swing high from October 17th. We get above 195 and that coincides with a close above the 50-day moving average. That would be more bullish. I like the IYT setup more so than the SMH. It's just simply a little cleaner. Take a look at GOOGL, Google. We just can't break above these moving averages. We started to on Wednesday, and there was no follow-through whatsoever rolling over. We still need to get above the 50 and the 200-day. So from a coagulation standpoint, I like using that word, you have a confluence coming in there right around 1140. We get above 1140, that would be somewhat bullish for Google. Now, how about YELP? This one got YELP. This lost the most dollar value on Friday. I mean, it was epic. It closed the day at 43.50. Excuse me, it closed Thursday at 43.50. It was as low as 29 something and closed at 31.93. That was just taken out behind the woodshed and then some. If I bring in all the data on YELP, according to Thinkorswim, we're teetering on that swing low from 2017. Otherwise, it's down here at 20. So YELP is yelping at the moment. I had a question on Eli Lilly. And the question was coming from, from a technical standpoint, how does it look? Well, it was going nowhere for a while, August to October. Then sort of getting the first week of October, it starts to pop. Then it fills the gap. Now we're starting to roll back up. Eli Lilly is really short term. It's just in a big old trading range. That's it. If it breaks above 115 on a closing basis, that will be a breakout and that will be bullish. So if bear calls are placed at or above resistance, they can potentially work. Or bull puts placed below support, below 105 could potentially work. So as a new strategy, bear call, bull put, right now it's just range bound. Short term though, it is bullish because we're starting to push a little higher here. Here is SGMS. I reviewed this one. Oops, if I can spell. I reviewed this one just on Thursday, and I said, hey, there's some amazing potential upside targets here. Yeah, that was all given back on Friday. So what do you do? Or I can tell you what I would do. If I was bullish on SGMS and I like the action on Thursday and then it just rolls over, you got to have a stop. If you don't have stops, you're just going to drive yourself more crazy than maybe you already are. I think as traders, we're all a little crazy, but we finished below the close, below the open price. We even closed below all the moving averages, below the 50-day in orange, the 5-day in blue, the 20-day in red. I like to use the 20-day EMA as a trailing stop. Well, that got obliterated too. So this one's just a dead duck. It would now need to take out Thursday's high on a closing basis for me to even consider wanting to be long from a swing trading perspective. CREE, this one I like because from a technical perspective, it just launched right through that 200-day moving average. Target swing high at 47.50, just under 10% higher, and then the previous swing highs back in August. I like the volume break there. Here is AZUL, which is AZUL, bottom, and we just had earnings. Now, according to Thinkorswim, earnings were on 11.8. We had a little move up. If we take out those previous highs, that's what I'm looking for. Take out of the previous highs, the triple top-ish up near 35 would be the target. I think a 20-day EMA could be considered as a trailing stop for me. And again, it's always from an educational perspective. Paper trading, virtual trading is free. There's absolutely no risk to that. Great way to learn. And then emerging markets. I haven't looked at this in a while because we just keep going lower. We can't break these trend lines. We were down on Friday again. Just bearish, and more bearish. So that's it, folks. Wish you guys a fantastic week ahead. Again, happy Veterans Day out there. And doing videos probably every night, but if I miss a night, it just might be because Vegas is just a little too crazy. But I look forward to seeing you in the next video. Take good care, gang.